Are you ready to take your trading to the next level? In this video, we are diving into the continuation of candlestick patterns that signal powerful trend reversals. If you missed part 1, don't worry, you can catch it later. Now let's get started. In our previous video, we covered patterns like the bullish engulfing, the railroad track, the bearish engulfing, and the hammer and inverted hammer patterns. Today, we'll explore even more reversal signals that can transform your trading strategy. Number 6. The dark cloud cover candlestick pattern. The dark cloud cover candlestick pattern is a bearish reversal pattern that signals a potential change in an uptrend. It forms when a bullish candlestick is followed by a bearish candlestick with specific characteristics. Now, the key features of these candlestick patterns are: 1. It appears during an uptrend, indicating the possibility of a reversal to a downtrend. Secondly, a large bullish candlestick reflecting strong buying pressure. Thirdly, the second candle opens above the high of the first candle, gapping up. Now, it closes below the midpoint of the first candle, showing a significant bearish move. What is the psychology behind this pattern? The gap up at the start of the second candle creates optimism. However, the strong bearish close below the midpoint of the first candle indicates selling pressure, suggesting that bears are taking control. The dark cloud cover is often compared to the bearish engulfing pattern, but it is distinct due to the specific requirement of the second candle opening above the previous high and closing within the first candle's body. How to trade the pattern? Now, this pattern must be observed at key resistance areas. You can enter a sell after the confirmation or completion of the pattern. You place your stop loss above the high of the second candlestick. You take your profit on the nearby support level or target a risk to reward ratio of 1:3. Number 7. The Tweezer bottom candlestick pattern. The Tweezer bottom candlestick pattern is a bullish reversal pattern that typically appears at the end of a downtrend, signaling a shift to the upside. It consists of 2 consecutive candlesticks with matching or nearly identical lows, indicating strong support at a certain price level. What are the key features? 1. It occurs during an existing downtrend, signaling a possible reversal to the upside. 2. It involves 2 candlesticks. The first candlestick is a bearish down candlestick with a long body, while the second candlestick is a bullish candlestick with a long body opening at or near the first candlestick's close. Number 3. The lows of both candles are at the same or very similar price levels, showing strong support. Number 4. The inability to break below the previous low suggests that sellers are losing momentum and buyers are stepping in. What is the psychology behind this pattern? The first candle reflects strong selling pressure. The second candle opens lower or at the same level, but buyers enter the market aggressively, pushing prices up. This suggests a shift in market sentiment from bearish to bullish. How do we trade the Tweezer bottom pattern? We wait for confirmation or completion of the Tweezer bottom candlestick pattern at a support level. We enter a long position after the confirmation candle closes above the Tweezer bottom pattern. We place the stop loss below the lows of the Tweezer candles and we take the nearest resistance levels as our take profit position, or use a risk to reward ratio of 1:3. Number 8. The Tweezer top candlestick pattern. The Tweezer top candlestick pattern is a bearish reversal pattern that occurs typically at the top of an uptrend. This signals that the trend may reverse to the downside. It consists of 2 consecutive candlesticks with matching or nearly identical highs, indicating a loss of bullish momentum. What are the key features of this candlestick pattern? It occurs during an existing uptrend, indicating a potential reversal in price direction. Secondly, a bullish candlestick with a long body is the first candle, while the second candle is a bearish candlestick with a long body opening at or near the first candle's close. The highs of both candles are at the same or very similar price levels, showing strong resistance. The inability to break above the previous high indicates that the buyers are losing strength and the sellers are taking control. What is the psychology behind this pattern? The first candle reflects strong buying pressure. The second candle opens higher or at the same level, but sellers enter the market aggressively, pushing prices down. This suggests a shift in market sentiment from bullish to bearish. How do we trade the Tweezer top candlestick pattern? We wait for confirmation or completion of the pattern at a resistance level. We enter a short position after a confirmation candle closes below the Tweezer top pattern. We place our stop loss above the highs of the Tweezer candles, and then we take profit at a nearby support level or use a predetermined risk to reward ratio of 1:3.
Number 9.
The morning star candlestick pattern. The morning star candlestick pattern is a 3-candle bullish reversal pattern that signals the end of a downtrend and the beginning of an uptrend. It is widely used in technical analysis to identify potential buying opportunities. The key features of these candlestick patterns are: number 1, the first candle is a large bearish candlestick indicating strong selling pressure, while the second candle is a small-bodied candle often resembling a doji or a spinning top. This candle shows indecision in the market and could gap down from the first candle. The third candle is a large bullish candle that closes well into the body of the first bearish candlestick. This confirms the reversal. What is the psychology behind the candlestick pattern? This pattern shows a transition from selling pressure to buying interest. The first candle reflects the continuation of the downtrend, while the second candle represents a pause in the trend, signaling indecision or potential exhaustion of sellers. The third candle, on the other hand, demonstrates buyers regaining control and potentially starting an uptrend. How do we trade the morning star candlestick pattern? We wait for confirmation or completion of the pattern. The morning star is more reliable when the third candle closes above the midpoint of the first candle. We enter a buy trade at the close of the third candlestick. We place our stop loss below the low of the candlestick pattern and target a 1:3 risk to reward ratio, or take our profit at the next available resistance level.
Number 10.
The evening star candlestick pattern. The evening star candlestick pattern is a 3-candle bearish reversal pattern that signals the potential end of an uptrend and the beginning of a downtrend. It is the opposite of the morning star pattern and is widely used in technical analysis to analyze selling opportunities. The key features of this candlestick patterns are: the first candle is a large bullish green candle indicating strong buying pressure, while the second candle is a small-bodied candle often resembling a doji or a spinning top. This candle shows indecision in the market and could gap up from the first candle. The third candle is a large bearish candle that closes well into the body of the first bullish candle, and this confirms the reversal. What is the psychology behind this pattern? The pattern represents a transition from buying pressure to selling interest. The first candle shows the continuation of the uptrend, while the second candle indicates indecision or hesitation among buyers. The third candle demonstrates sellers gaining control and signaling a potential downtrend. How do we trade the evening star pattern? We wait for confirmation or completion of the candlestick pattern. The evening star is often more reliable when the third candle closes below the midpoint of the first candle. We enter a sell after the completion of the pattern. We place our stop loss above the high of the candlestick pattern and target a 1:3 risk to reward ratio. And now for our bonus candlestick pattern of the day, we have a look at the doji. Yes, the doji candlestick pattern. The doji candlestick pattern is a significant pattern in technical analysis, often indicating indecision in the market. It forms when the opening and closing prices of a security are nearly equal, resulting in a candlestick with a very small or non-existent body and long upper and lower shadows. We have different types of the doji candlestick pattern. We have the neutral doji. The neutral doji has an equal upper and lower shadows, indicating complete indecision. 2. The long-legged doji. The long-legged doji has a long upper and lower shadow, showing significant price fluctuation but no trend direction. 3. The gravestone doji. The gravestone doji has a long upper shadow and no lower shadow, indicating potential reversal in a bullish trend. 4. The dragonfly doji. The dragonfly doji has a long lower shadow and no upper shadow, often signaling a reversal in a bearish trend. Number 5. The 4 price doji. This is an extremely rare candlestick pattern with no shadows and no bodies, suggesting an extremely quiet market.
Mastering candlestick patterns is the key to smarter trades.
If you found this video helpful, give it a thumbs up, share with your trading community, and don't forget to hit the subscribe button for more trading insights. Remember to check out part 1 of this video if you haven't already. See you in the next video.